CAPM has been lying to you about risk. If you're into finance, you've likely become intimately familiar with the idea of beta. You know beta as a stock's sensitivity to the overall market, where a beta of 0.5 means that the stock moves half as much as the market, and a beta of 2 means the stock moves twice as much as the market. Essentially, regression beta is supposed to measure risk. It assumes that your stock is equally sensitive to the overall market in both up and down periods, but empirically we find that this often isn't the case. Traditional beta, which you learn about in your introductory corporate finance class, fails to account for different market regimes. Just because a company has a lower beta does not make it a safer investment, and this is something that CAPM completely ignores. So over the last week, I've been exploring something known as nonlinear beta to try and answer the question, are stocks more sensitive depending on market direction? I tested all 500 S&P component stocks in my latest project, which is completely open source and available on my GitHub, which you can access through the link in my bio. To start, I split over 1,000 trading days based on SPY returns into up days or down days. For all 503 component tickers, I regressed stock return on market return for both up and down days separately. Essentially, I ran 2 regressions for each company, one for when the market was up and another for when the market was down. This way, I would be able to determine how sensitive the stock was in both environments. Then I took a ratio of the 2 slopes, dividing beta plus by beta minus. This is just to normalize the entire data set for overall sensitivity to markets. I don't really want to be comparing infotech to consumer staples. They're going to have vastly different betas to begin with. I just want to compare for each company if it reacts more towards bullish markets or if it reacts more towards bearish markets. Unsurprisingly, the average beta for all S&P stocks was 1. Meaning that in aggregate, companies were equally sensitive to both up and down market movements. This alone is pretty boring, so I split the S&P 500 into its 11 GICS sectors, and I found that energy had on average the lowest beta ratio of 0.75, and industrials had the highest at around 1.08. This suggests that sensitivity to the market is very dependent on whether the market is going up or down. Going further, I filtered for the most beta asymmetric stocks, basically the magnitude of the beta ratio being very high. The full list is available on my website. We should be thinking of how a stock performs in both up and down markets, not just about its overall sensitivity. For this reason, I think that beta ratios are a powerful tool to use in portfolio construction. If you like this type of content, feel free to follow, and as always, thank you and have a great rest of your day.